Trading macro events. Strategies for success. Macro events are scheduled economic releases, announcements, or events that provide information about a country's economic performance, monetary policy, or geopolitical stability. Traders and investors closely monitor these events to gain an edge in financial markets, as they can serve as leading indicators for future market movements. These events include economic data releases, central bank announcements, geopolitical developments, and more. Traders closely monitor these events because they have the potential to significantly impact asset prices, including currencies, stocks, and commodities. When a significant macro event is released, be ready to execute your trades swiftly. Ensure you have a fast and reliable news source to receive real-time updates. Stay informed about upcoming macro events by regularly checking the economic calendar. Plan your trades and set entry and exit points based on different scenarios. Regularly check economic calendars and news sources to stay updated on upcoming macro events. Be aware of the event's significance and its potential impact on the assets you trade. Economic releases can lead to market volatility, particularly if the data significantly deviates from expectations. Be prepared for potential price movements in currency pairs, stocks, and related assets. Economic data, including retail sales figures, are often subject to revisions in subsequent releases. Keep an eye on any revisions that may impact market sentiment. Just a quick reminder to please destroy the like button and hit the subscribe button. Also, visit us at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. Some of the more popular macro events you will find on the U.S. economic calendar are Non-Farm Payrolls, or NFP for short. The NFP report, released on the first Friday of each month by the U.S. Bureau of Labor Statistics, provides information on the number of jobs added or lost in the United States. It's a critical indicator of the country's economic health and can move currency and equity markets significantly. Trading strategy. Traders often position themselves ahead of the release, expecting volatility. However, it's essential to have a risk management plan in place due to the NFP's potential for surprise. Interest rate decisions. Central banks, such as the Federal Reserve or the Fed in the US and the European Central Bank or ECB, regularly announce their decisions on interest rates. These announcements have a profound impact on currency markets and can influence stock and bond markets as well. Trading strategy. Traders often focus on the central bank's tone and any hints about future rate changes. A hawkish tone, indicating potential rate hikes, can strengthen the local currency, while a dovish tone, suggesting rate cuts, can weaken it. However, be cautious of sudden market reversals and use proper risk management. Consumer Price Index, or CPI for short. The CPI measures inflation by tracking changes in the prices of a basket of goods and services. High inflation can lead to higher interest rates, impacting various asset classes. Trading strategy. Before trading the CPI, it's crucial to understand what it represents. The CPI measures changes in the prices of a basket of goods and services that the average consumer buys regularly. A rising CPI indicates inflation, while a falling CPI suggests deflation. Retail sales. Retail sales data indicate consumer spending trends, a critical driver of economic growth. Strong retail sales figures can bolster stock markets and the local currency. Trading strategy. It's essential to understand what it represents. Retail sales data measures the total sales of goods and services sold by retailers during a specific period, typically on a monthly basis. A rising retail sales figure is seen as positive for the economy, indicating strong consumer spending, while a decline may signal economic weakness. Earnings reports. For stock traders, corporate earnings reports are crucial macro events. These reports reveal a company's financial health and future prospects, impacting stock prices. Trading strategy. Pay attention to earnings estimates and the company's guidance for future performance. Traders often take positions before earnings announcements, but beware of earnings surprises. Gross domestic product, or GDP releases. GDP reports provide insights into a country's economic performance. Positive GDP growth can boost investor confidence, while negative growth can lead to market pessimism. Trading strategy. Traders analyze GDP data relative to expectations. A GDP growth rate higher than expected may drive the local currency higher and vice versa. It's crucial to watch for revisions and broader economic context. Geopolitical events. Events such as elections, trade negotiations, and geopolitical conflicts can have a significant impact on markets. For example, Brexit negotiations affected the British pound's value, and the US-China trade war influenced global equity markets. Trading strategy. Stay informed about the latest geopolitical developments and their potential consequences. Be prepared for volatility and adapt your trading strategy accordingly. Understand how different asset classes, e.g., currencies, stocks, commodities, react to specific macro events. Utilize this knowledge to diversify your portfolio and hedge against potential losses. Combine technical and fundamental analysis to make informed trading decisions. Technical analysis helps identify entry and exit points, while fundamental analysis provides the broader context. Test your trading strategies on historical data to assess their effectiveness under different market conditions. This helps you refine your approach and gain confidence in your trading plan. Stick to your trading plan and avoid emotional reactions to market volatility. Embrace losses as part of the trading process and learn from them. Use appropriate risk management techniques, such as setting stop-loss orders and position sizing, to protect your capital. Volatile macro events can lead to rapid price movements, so be prepared for sudden market shifts. Create a trading plan. Identify potential entry points based on your analysis. For example, if you anticipate strong retail sales growth, you might consider buying shares in retail companies or a retail sector ETF. Implement risk management by setting stop-loss and take-profit orders to limit potential losses and lock in profits. Determine the size of your position based on your risk tolerance and the potential impact of the retail sales release on your portfolio. Conclusion. Trading macro events can be highly rewarding, but it also involves significant risks. Success in trading macro events requires a combination of knowledge, preparation, and disciplined execution. By staying informed, managing risk, and using a well-thought-out strategy, traders can navigate the complexities of macroeconomic events and potentially profit from them in the financial markets. Thanks for watching.